Let's welcome in Pratik Gupta, who's with us, CEO and co-head at Kotak Institutional Equities. Pratik, great to have you with us here on the program as always. Thanks for your time. Do you think one of the reasons, sort of almost primary reasons, of course, earnings have been tepid, etc. We all know that, but there's so much supply, right, which is constantly hitting the market. Just take SBI's 25,000 crore round and so many others who are kind of sort of coming to the market and quietly raising money, successfully raising money. So there's a fair bit of supply. So money is getting sucked out of the system. What is your sense? I mean, on balance, because very, very evenly, almost sort of, these levels, at least on the index level, things are pinned to the board, not moving very much, very tight band.
Yeah, good morning, Prashant. I was actually just discussing with someone earlier this morning that our market seems to be, if you remember the old Ajit Mona Darling jokes, like in a liquid oxygen state, pretty much range bound. You've got, on one hand, you've got the very weak earnings outlook, as you mentioned, valuations which are expensive. Nifty is trading at almost 22 times 1 year forward. And you've got a huge paper supply pipeline. We had SPI yesterday, many other large IPOs and a lot of blocks and QIPs in the pipeline. So that's going to sort of cap the upside. And on the downside, there's a lot of support from continuing local flows because your alternatives in fixed income property are no longer that attractive. You have the prospects of a much stronger second half. So there's hope that earnings will recover in the second half. And then you've got the US dollar weakness, which will hopefully trigger EM inflows as we go along in the next 3 to 6 months. So sort of stuck in a range-bound mode for the short term and pinned to the wall, as you said. So it's pretty frustrating for a lot of investors who are either waiting for a market correction to buy or waiting for a market rally to sell. So pretty subdued activity for the time being.
That line, Pratik, I was hoping that when you started with the Mona Darling line, I thought you'd say it. मोना डार्लिंग इसको लिक्विड ऑक्सीजन में डाल दो लिक्विड इसको मरने नहीं देगा ऑक्सीजन इसको जीने नहीं देगा that's the line.
Gentlemen, out of the park this morning. I went to Google immediately. Ajit Mona Darling.
I mean, how can you, Nigel? I mean, you're not that young. This is,
now it feels like a Friday. Actually, thanks for that, Pratik.
But Surabhi, I've heard about this.
Old movies playing in the house at some point in time.
Surabhi, come on.
This is not 90s. We're like 90s kids and all.
This is iconic.
No, but okay, to bring this back to the market, Pratik, please elaborate. Now, who is the Mona Darling? Which sector? What is the liquid oxygen? Is it the liquid flows? Please elaborate on this very, very interesting analogy that you picked up this Friday morning. Because if you're talking about flows, then that liquid oxygen is not even there. Where are the FPI flows? Half the year is gone. We thought there'll be plenty of liquid oxygen, but it's not coming.
No. In the joke, the liquid is the thing that prevents will kill the guy, and the oxygen is what will give him these support to kill.
Okay.
So the liquid in this case, what will kill the guy is really the valuations which we are at 22 times. Very few stocks are at attractive valuations. Earnings growth, as Prashant was saying, is pretty pathetic. If you look at the large sectors, you look at IT services, consumer, banks, you'll get, at best single-digit earnings growth this year. So that's sort of what's capping the upside. And in terms of the downside support, you've got local flows because, like I said, money is not going anywhere else. It's coming into equities, risk capital, that is. And you have prospects from, for example, you could see the impact of the rate cuts by the RBI and potentially even more rate cuts given the very low inflation print we saw in June. You could see, finally these things feeding through into the economy and the long sort of, and you could see government capex coming through in the second half. Post-monsoons, we could see a rural recovery. All of these factors should come together in the second half. So therefore, it's sort of pretty range bound at the index level. Obviously, individual stocks are doing their own things, but at the broader market level, tough to see this market moving out of the sort of range.
Now it makes full sense, Prashant. So liquid ise jeene nahi dega is the valuation and the earnings. But oxygen marne nahi dega. That's the retail money flow. Now we understand.
I remember the dialogue, but you got to go with Ajit's delivery. I mean,
You nailed it.
I can do it, but I don't want to do it.
Over it, Prashant.
And you should try it.
Yeah.
On popular demand.
Lights, camera, action.
I'm not going to do it. Go on. By the way, just to take that point forward, Ramdevji was on, right? And I don't know if you watched that conversation, Pratik. This liquid oxygen, basically he put it another way. This is, of course, but Ramdevji said cap and floor. The cap, according to him, is all the supply which is coming in, and the floor is all the supply, all the sort of money which is coming in.
Retail money, yeah.
So, and that's the liquid oxygen, which I think that's another way to describe liquid oxygen.
All right, interesting Friday morning, Pratik. We started off, we had our top 10, and Surabhi was asking Rima, the glass is full or half full. It's a Friday morning, so I was just wondering what's going on. And now we have a slew of jokes as the markets open. Let's get back to earnings. We spoke to Mahesh of Jefferies last week, and he said quarter one is going to be weak, but he's breaking for a very strong bounce back in quarter two earnings. And the rationale he gave us, that it's going to be on a softer base. Some part of this liquidity that's released into the market will start picking up. And since we are hit by early monsoons, maybe the monsoons recede as well earlier. And besides that, the most important is Diwali is relatively earlier. So spends will pick up in September. Are you in that camp that believes that we'll see a good earnings recovery in quarter two? And for the year, you're still sticking to that 12% earnings growth?
So yes, Nigel, we also believe that the earnings growth outlook will be much better in the second half. For the June quarter, our projection is at Kotak that the Nifty earnings, for example, will be growing only by about 4.5% YOY. Whereas for the full year, we are projecting about 11% for FY26. So clearly that means in the next 3 quarters, we should see a much stronger earnings growth. Having said that, a lot of it is priced in already, both the negative news as well as the second half recovery, negative news of the first quarter and the second half recovery. Just look at the valuations of where all the stocks are trading at. You, like I said, you look at the consumer stocks, the IT stocks, the bank stocks. They're already sort of, I don't think there's going to be a major surprise, barring a few odd stocks here and there, that broadly almost every investor is expecting a very weak set of earnings from the first quarter and a pickup in the second quarter. I think the main market moving events will be something other than what's already going on, all this second half recovery. It could be things like you get a favorable trade deal with the US, for example, or perhaps on the downside, an unfavorable trade deal. So that could be one. Second, you could see some government action in the form of, say, perhaps petrol and diesel price cuts at the retail level. That could pump some money back into the economy. GST, we think there'll be just some minor tweaks, but perhaps there could be something more over there. But I think the real big trigger will have to be things like government capex coming in a big way in the second half. And that's always a bit tricky to project how much of it will be driven by the center, by the states, the PSUs. So that's really where we are. So we are sort of expecting a much better second half, but it's sort of priced in. So to break out, you need something else happening, which at least at this point in time, there's nothing going on.
Okay, so all right, Pratik, let's sum it up then with what should be done. I mean, you described the situation really well, and I think this is the reason why we're not getting that deluge of foreign flows. We started the year expecting that US exceptionalism will end, and it has, but it's Korea and China where the money seems to be going. So in this context, what should investors be doing? Where do you see some prospects of growth and some valuation sanity? Leave us with the top ideas. I think defense is something you've always liked. What else?
So firstly, on the foreign investor side, I'd just like to highlight that most global investors are still neutral to largely underweight India, just given the expensive valuations. India has underperformed the MSCI EM index. You mentioned Korea. Korea is up 32% this year in local currency terms. Other markets like Hong Kong or Brazil and Mexico, they're up 15, 20%. So India is clearly underperforming. But even then, people are staying away. And you've seen the flows into the FPI flows into India last few weeks. We haven't seen that much coming in. Now, as far as the sector preferences are concerned, in this sort of a market environment, either you go with companies where you have strong earnings growth visibility or where valuations are in your favor. And that's a tough one to find. So we still like the banks and the NBFCs and the insurance companies where earnings growth is not that great, but at least valuations are somewhat reasonable. We still like the hospital space, the entire healthcare space, where again, in this case, valuations are not supportive, but you have very strong earnings growth outlook for the next couple of years. Hotels is another area. Telecom is another area. So these are sort of the sectors we like. One general theme we would recommend investors, at least for the time being, to stay away from is export-oriented plays. These are like IT plays, the global auto ancillary plays, or the metals. We believe a global slowdown is in the works. The impact of the tariffs, etc. Already we're seeing this in China slowing down. US we think will slow down in the second half. So when two large engines of the global economy slow down, tough to see the overall global economy not slowing down. So overall, we would stay cautious on the global export plays, focus more on the domestic plays.
Okay, all right, Pratik, thank you very much. A great conversation as always, insightful and, might I say, very entertaining, brightened up our Friday morning. You have a great day and we look forward to connecting.
I hope you'll
By the end of this day, you'll have to enact. If not on air, off air, for sure.
You'll give the idea to Sanjeev, Pratik, the research note titled Liquid Oxygen. I think it'll be a super hit.
Pratik, I'm sending you an invite for drinks later this evening, and we'll do all the enacting over there. All three of us and you.
Okay.
All right. Thank you very much, Pratik. Appreciate you joining us as always, and good chat. And look forward to the next one. Guys.